Good morning, everyone, and thank you for joining today's webinar presented by Altfest Personal Wealth Management. My name is Jesse Frailing. I am the Director of Retirement Plan Services here at Altfest, and I will be your moderator for today's webinar. First and foremost, on behalf of our entire team, we want to wish continued health and safety for you and your families. As we all know, the challenges we face today as a society come in many forms: social, economic, medical, psychological, as well as others. And as a firm whose service extends far beyond investment management, we understand that everyone is experiencing this time differently and has unique needs and circumstances which require a customized approach. Here at Altfest, we continue to work very hard to help each of our clients navigate through these times of uncertainty and at the same time uncover opportunities that every crisis carries with it. We'd like to especially recognize the New York State Dental Association. Altfest is proud to have been the preferred wealth manager for New York State Dental Association members since 2010, and we are incredibly thankful to have the opportunity to continue to provide a range of benefits as well as timely content and education specific to the needs of dentists. If you're not familiar with Altfest Personal Wealth Management, we were founded as a fee-only financial planning firm in 1983 and currently manage about $1.3 billion in client assets. As a fiduciary, it is our mission to always put the best interests of our clients first. We offer truly comprehensive financial planning and investment management and specialize in providing services tailored specifically to the needs of dentists. Now I'd like to introduce today's speakers, Stephen Novack and Ben Lake, both of whom are senior financial advisors at Altfest Personal Wealth Management. Today's topics of conversation will be tax options to take advantage of in a lower income year, refinancing your personal or commercial mortgage, and identifying investment opportunities in a volatile market. If you have questions during the webinar, please feel free to type them in the chat box on the left-hand side of your screen. We will do our best to answer as many questions as possible at the end of the presentation. And for any questions we cannot answer live on the webinar due to time constraints, we will be holding a Q&A via email after the webinar ends. And before we begin, I also wanted to make sure everyone knows that we do have a very brief survey that will pop up on your screen after the webinar has ended. It takes less than a minute to complete this survey, and it would be very helpful to us if you could complete this after the webinar ends. With that, I will turn the presentation over to Stephen Novack to get us started. Stephen?
Thank you, Jesse. Today, we're going to start talking about what tax opportunities exist in the marketplace right now. But to give you a little more of a history, one thing that Jesse did not say about me, I understand the dental practices pretty well. I'm a son of a dentist. My father practiced for 50 years and retired about 5 years ago. He also taught, if anyone ever went to Fairleigh Dickinson University, he worked in the operatories there for about 15 years until it closed. All right, now to go into the topic. Next page, please. All right, so what are we talking about here from an income standpoint? You know, this is a little bit of a unique year in the sense that we're expecting lower incomes. So we want to try and take advantage of that, especially if your tax bracket's expected to change. I'll show a sample at the end of this section of a client that I'm doing projections on that'll give you some numbers and show you a little bit more how this works, what I'm discussing right now. We're looking to, if you're expecting your income to be lower in a lower tax bracket, we'd like to utilize some of those lower brackets. So we'd like to see what type of income we can generate. As listed here on the screen, what you're looking at, receivables. If you have money that you're owed and you haven't recognized yet, if you can go out and try and bring that in to increase the lower, fill up the lower tax brackets, that's worthwhile. Sale of assets. It could be capital assets. It can be other equipment or something that you have some form of a gain on that you want to recognize to bring up your total your total income for the year. One that we've discussed on a prior conversation, and if you are interested, you can give us a call and please reach out to us and we can have more detail, because I'll kind of just glance over this right now, are Roth conversions. Roth conversions allow you to take money out of a retirement plan, a taxable deferred retirement plan, pay the tax on it now, and then when you take the money out, when you are fully retired or you need the money, or you pass this on to your next generation, there's no tax paid later on. The goal of this would obviously be to pay the tax at a lower bracket than a higher bracket. So if you are in the lower bracket this year, it makes it an opportunity to do it. Could be a one-time thing because you expect your income to be higher going forward, and it will grow tax-free for the remainder of the life. But as I said, if you do have other questions and want to know more about this opportunity, please give us a call at Altfest, and we can find someone who will talk to you through your current situation and review numbers with you. Expenses. What are we trying to do with expenses here? Well, I'm talking about actually increasing your income by changing your retirement plan. If your company is taking deductions for contributing to retirement plans for yourself or potentially employees, it might not make as much sense if you're in a lower tax bracket. You're losing some of that benefit. If you have, an option to do something to pay yourself December or January, it might make sense to do it in January, where next year you'll have a higher tax bracket. If you go from the 32% bracket down to a 24 just federally, not even including states, and you're talking $10,000, that actually is a loss of savings of $800 right there. So that's something that we can review with you also. Itemized deductions. If you're in a lower tax bracket, then your Schedule A is going to be reduced. The benefit of your Schedule A is going to be reduced. That's giving money to charity. If there are medical expenses, if you're over the threshold and you're deducting some of those. So some of that might be beneficial to push off to another year. Again, this is all very specific to each individual situation, so it's kind of hard to give you numbers on how this is going to work, but that's really what some of the goal is. Business expenses. If your income is lower, if you have any major equipment purchases, equipment that you need for ongoing running of the business, makes sense to purchase. But if there's any larger equipment, again, that you can push off till January and a year that you think your tax bracket is going to be higher, it might make sense to do something like that. I know your goals right now are to get the businesses back up and running. We understand. I know I'm getting notifications from my current dentist that they're going to start. It looks like about the first week of June on an ongoing basis. I've spoken to a friend who's an oral surgeon. And he's starting to do it, and he's sent out an entire procedure list of how they're doing it. So this, I understand, is your major concern is obviously getting patients back in. A client of mine who wanted to join today just got an emergency call and notified me that, so people are coming in. So the question is, how are we going to get the businesses back? And let's try and do this in advantageous ways for each of you. Next slide, please, Jessica. Here's the sample that I was kind of talking about. This is an internal system that we have that we can run, tax scenarios for you. The first column is someone's current or prior year tax return, and then we were trying to figure out what adjustments we were going to be making. We left everything the same. This dentist's wife has a small job. They have some taxable interest, dividends, qualified dividends, some short-term gains. They're not deducting anything. It's a standard deduction. So you can see overall, they have approximately $400,000 in income and are paying tax at about $110,000. That includes self-employment tax and everything else. We only are making one change in the scenario, and that was to assume approximately 30% of the business income was going to be reduced this year. And you can see that in the adjustments column, the reduction of the $100,000, going from $350,000 for the practice down to $250,000. The first thing to note is the reduction in the self-employment tax. You deducted almost $13,000 last year, and this year we would expect that to go down. That's because you're paying $3,000 less in self-employment tax, so your deduction will go down about $1,500. And then the total tax, you'll see we're going down about $30,000. So almost 30% of that number. That includes the self-employment tax, that includes the regular tax on the other income. But what we're noting here in the example I was giving when I was talking before is the ordinary income tax brackets. When you see that, they were in the 32% tax bracket last year, and this year he's in the 24% tax bracket. So he has extra room in that 24% tax bracket of about, I think it was $55,000. So if we can ramp up his income to that, even if you go over a little bit, it's not gonna hurt you that badly. But the goal is to, utilize the lower tax bracket as much as we can to, recognize income faster as long as you have the liquidity to do it, and reduce some of the expenses. And it's a game between those two sets of numbers to try and, maximize that 24% tax bracket. Again, this is something that if you have a tax return, want to give us a call, we can run scenarios for you and talk about it and provide something like this that will show you or, discuss what is best for your current situation. This obviously is a fluid in numbers. As the year goes on, you'll want to keep updating this. We can do estimates now and also update as the year goes on. You have more realistic ideas of what the actual income will be through 2020. Next, I'm going to switch over and we're going to talk a little bit about mortgage refinancing. Mortgage refinancing right now, the current situation that we're looking at, next slide please, that we're looking at is what's worthwhile to do. And the first question always comes up, how long do you plan on owning your home? If you plan on staying in your house only for a few years, let's say 5, 7 years, somewhere around there, probably is usually not worthwhile doing the mortgage refinancing because you have a upfront cost that you have to save. You might save a little bit, but it's usually not that much. The types of mortgages you have currently and the types of mortgages that are available to you. Conventional loans, when they talk about, that's what you hear about most on TV. That's the agency loans, Fannie Mae, Freddie Mac, Ginnie Mae, VA loans, if you're a veteran, USDA, which is not gonna be too important for the dentist. Then there's non-conventional, the jumbos. If you're over the regional threshold, you're gonna need a jumbo. The limited documentation loan. This is something my father had to do, and this is something that a lot of dentists will have to do because you're not a W-2 employee. You're, Schedule C, or you might have some form of business that depends on the documentation the bank is looking for. Sometimes they view the Schedule C as, not enough information for them to give you a conventional loan, and you'll fall into the non-conventional. Typically, that means a little bit higher of an interest rate. Then from an interest rate standpoint, we have 3 major categories. You have fixed rate. Obviously, this is probably what most of you do have. You have a rate that's set for 15 years, 20 years, 30 years, and you're gonna pay the same rate the whole way through. An ARM, which is an adjustable rate mortgage, allows the rate to change after 3 years, 5 years, 7 years, depending on what the terms are. Usually it's indexed to like LIBOR plus a spread or the Treasury plus a spread, and that will move. Some of them do have caps and floors, which would mean that it will never go above. If you started at 3%, it can only go up to like 9%, up 6 points, and it can go down to 0. You'd have to see what the terms of those are. Interest-only loans, I don't know if any of you have any of those. Those were much bigger around 2008 than they are today, but there's potential to have, let's say, a 5-year or 10-year loan mortgage that you only pay interest at the beginning. Usually these are paid off in what I'll call a bullet, but basically a balloon payment at the end of that term, at which time most people would refinance unless they have the cash to pay off the entire mortgage. Now let's talk about what factors we're looking into the current mortgage. Number 1, rate. You currently have a 4.5% mortgage, and we're looking at another 30-year. Okay, we can probably get you somewhere around a 3.5. I even just did a client, which I'll show an example in a sec, got a 3.25. They were down in Virginia. Rates are specific to states. States do move a little bit. Closing costs. Sometimes you'll pay a point up front to buy down the interest rate. And what this means is if you have a $300,000 mortgage and you pay 1 point, you're going to have a charge of $3,000 up front. You'll pay for an appraisal of the property, title insurance, probably some type of title review. They're going to want to make sure that you do actually own the property and that. State and local recording fees. This varies by state a lot. New York has one much higher than New Jersey, which is where I live. Virginia, the client I'm just working on, had approximately about 1/3%, but they do have recording. So that's goes into the total closing costs, which you have to evaluate versus your savings. Current balance. Okay, you think you have a mortgage, it's $300,000 balance. Well, let's say you have $4,000 in closing costs. You can pay that money up front. You can do what's called capitalizing it and add it to the balance and then just pay it off over the term. Capitalizing it usually doesn't have that much of an effect on the overall monthly payment. That's a decision to evaluate and personal choice and what people like. And then term. If you have a 30-year and you're only a few years in, you probably stick with a 30. If you have a 30-year and let's say you have 18 years left, you might look at a 15. It might not save you that much in each payment to shorten the overall term you have remaining, but you might drop 3 years of payments off at the end at a lower rate. And those are things that we'll evaluate. So now let's go into the example that we were talking about. And this is something that if you needed, provide us information about your current mortgage, we can look for brokers and look at rates and provide you the information that we have and use our recommendations and try and help you out to lower the overall cost of your current mortgage. So this client had just bought this house about 2 years ago, and his current value of the mortgage is $670,000. He's got a 4 1/8 mortgage, which is 4.125, and as you see, he's just over the 2 years into, just shy of 2 years into the mortgage, so he's got 28 years left. His current payment is $3,366. The evaluation that we did for him was to take that balance and roll into a new 30. So he is extending the mortgage by 2 years of payments. The new rate is now 3 1/4. The closing costs were about $6,000. So the balance we're actually going to put into this mortgage was $676,000. So he is going to include that. And that payment, that savings, you see the $29.42, saves him about $425 a month. A quick and easy way of thinking about it is you want to take that monthly savings divided by your additional closing costs. Now, he's also adding on 2 years of payments in the end, so it's not quite that simple. But in this scenario, he will be saving $400 a month for 28 years, which will more than compensate him for that, for those additional 2 years at the end. Looking at this, what are we talking about? We need this to be evaluated, to look at the detail, and the major concern is obviously what your long-term goals are. One other thing I want to talk about, which you might have been hearing about, is the CARES Act. The CARES Act allows for agency mortgages. So we're talking the Freddie, the Fannie. So these are ones that are conforming mortgages to certain rules. You have the right to request a forbearance for 180 days, which means you do not make any type of payment on your mortgage for the 180 days. It doesn't mean you don't owe that money. You will owe that money, and you need to talk to the bank, your service provider, which would be on your mortgage statement, and find out how they're going to treat that. The forbearance can mean your mortgage is extended. They can ask you for the entire payment at the end of the period, or they can adjust your mortgage payments for the remainder life of the loan. There probably are some other options, but those are the main three that I've heard about. After the 180 days, you can ask for an extension. I don't believe that is a mandatory provider that they have to give it to you, but all this stuff has to be done through the service provider. If you have a non-agency mortgage, the jumbo or the limited docs, you have to, again, still call the service provider, but there are no official rules on that. So you have to see what they're willing to do for you. That one is, a little more on a case-by-case basis and a bank-by-bank basis. There's no federal rules within the CARE Act on how those are treated. Hopefully this was helpful. I would like to provide you any services. Please feel free to send emails to us and we can respond if you have any questions. But now I'm going to turn this over to Ben, and he's going to talk about the investment side.
Thank you, Steve, and welcome everybody. Thank you all very much for joining our webinar today. Just as Jesse and Steve described, we at Altfest take a very holistic and comprehensive approach to financial planning and investment management for all of our clients. And obviously it comes as no surprise that investments are an integral part of the financial plans that we create for our clients, all of which are designed to help them achieve their longer term financial goals and objectives. And I think that longer term perspective is very important, essential to keep in mind in times like this. It's often very easy for people to get swept up in headlines or emotional responses in times of such stress. But keeping that longer term goal focus in mind really helps us stick to achieving those longer term results people are looking for and maintaining a disciplined investment process. And so if there's one thing that I want everyone to kind of take away from today's webinar, at least from my portion of it, it's that even though we are continuing to face many challenges economically, and there may be continued risks of potential downturns or volatility in the investment market, that over time, we continue to believe that we will see a sustained recovery, and that when we look back on this time period, many years from now, 5+ years from now, no matter kind of when you decided to start putting investments to work or putting idle cash to work, it will have been a good time to be a buyer of long-term investments. And so with that in mind, I want to kind of explain how we're taking an approach to opportunities within the again challenged environment that we're seeing, because obviously earlier this year there was a very sharp, historically sharp downturn in markets, which broadly speaking lost between 30 and 35% in some cases in only 2 weeks. But due to kind of the speed and the extreme scope of measures taken by the government and governments across the globe to rescue the economy from free fall, we've been able to see this sustained, steady recovery ever since, and that continues to date. But that presents some potential future risks as well. And so I'm going to start weaving in some of our economic outlook now. And what you're seeing on the slide here is how the expectations might unfold going forward for the longer term impact of the fiscal stimulus on federal budgets and potential risks associated with that. So what you're seeing on the top side here is a measure that includes the CBO, the Congressional Budget Office's baseline forecast for federal deficits, which last year were at around 4.5%. They expect it to be similar going forward. But based on the most recent stimulus, this year that deficit may hit as high as 13.6 or even higher percent of GDP. And so that is a obviously a very extreme measure, and that may continue somewhat into next year. And what that could create is sharply higher levels of federal debt going forward. That could present future problems like rising inflation over time. It may eventually lead to budgetary constraints. And as our founder and chairman, Lou Altfest, mentioned on a recent commentary piece he put out, it could also lead to higher tax rates in future years and future administrations. And so that could present some issues from the perspective of a fixed income investor in particular, where yields on things like treasuries or the quality of those things may be thrown into question. And similarly, the Federal Reserve had an extreme level of monetary stimulus that created extremely important liquidity right when it was needed, really helping the financial system continue to function properly. But again, this presents some challenges, particularly for bond investors going forward. And so what you're seeing on this slide here is what's called the yield curve. The yield curve is shown on the right axis, or the horizontal axis, different maturity dates for US Treasury bills and bonds. And it starts at the short end with 3-month, 1-year, 2-year, and 3-year bonds. And then as it goes further to the right, you're seeing longer term bonds like 5, 7, 10, and even 30 years. And the vertical axis is showing the yields on those bonds. And what you're seeing in these two lines is that the gray dashed line is taken from kind of the midpoint of this most recent bull market back in 2013, where even though short-term rates were extremely low, longer-term bonds, 10, 30-year bonds, were yielding 3% or 4% or so. But now, with this most recent stimulus measure and monetary easing, the blue line is showing where the yield curve was at the end of April. And you can see that it's severely compressed. And this is intended to encourage people to not just save cash, to really invest it for corporations to spend, stimulate the economy, et cetera. But from a bond investor standpoint, it means that if you buy a 10-year treasury, you're only going to be earning 0.64% for 10 years. And even at 30 years, you're only earning 1.28%. And so this presents the real challenge that if inflation winds up closer to its longer term averages of 2 to 2.5%, by investing in securities like this, you actually might wind up losing purchasing power over time, not keeping up with inflation. And so that may force some bond investors to reach for yield in higher risk or lower quality parts of the bond market, such as high yield bonds or leveraged loans, for example. And so it's become increasingly important to focus on what are the risks in the kinds of fixed income securities that we're investing in for that part of our client portfolios. How do we make sure that we're being very selective in the kinds of managers we're working with in that space? Because another potential concern is that as obviously unemployment has been driven very high very quickly here, that tends to precede a rise in bankruptcies as well. And so obviously investing in bonds for a company going bankrupt is very challenging. And so even though we're a little more cautious on the fixed income side of the investment universe, we are much more constructive on the equity side. And these next few slides are going to highlight kind of why times like this, even though it might feel like you need some courage to be investing in equities at this time, tends to be good from a longer term perspective, and again, reaching those longer term goals. And so what you're seeing here is a table that shows in various years, going back 70 plus years, when unemployment rates are very high, above 6%, when they're kind of more average between 4.3 and 6%, and when they're quite low, the numbers on the right are showing what the S&P 500 have done. And the S&P 500 is a common benchmark for the largest stocks based in the US. And you see that when unemployment is above 6%, the S&P tends to earn annualized gains well above its average. Whereas when unemployment rate is very low and the economy is already very strong, it tends to potentially disappoint investors and earn much lower than its usual average. And the same is true if you look at it from the perspective of real GDP. And so what this next slide is going to show is that when real GDP is already very high, above 6%, forward returns for the stock market are often quite challenged because it's very difficult to sustain that level of GDP. However, when real GDP is extremely low or even negative, the stock market's often been decent, not perfect, but decent at being a leading indicator of a recovery. And so often that the case has been that the S&P 500 has had, again, outsized returns in those kinds of timeframes. And similarly, if we look at corporate earnings or estimated earnings per share growth of S&P 500 companies, again, the same story is true. When people are already expecting very high earnings growth, as they often do towards the end of bull markets, the S&P 500 is very challenged to actually meet those expectations. But when people are already forecasting, more muted growth or kind of dire concerns about expected earnings per share below 3.4%, again, you see the S&P 500 tend to outperform its longer-term averages and perform quite strongly. And so that's, obviously no guarantee that anything's going to happen in any one year. We take a long-term perspective, but it's certainly an indication that longer-term average results may be better for the stock market going forward, acknowledging the risks that there could be continued volatility. And this slide is also kind of a highlight of why being a long-term investor, why focusing on these long-term goals really makes the most sense. Because what you're seeing here is the range of outcomes that the stock market, bond market, and blended portfolios have experienced over different time frames. So you'll see that on the left here, in any 1 year time period, stocks, which are shown in green, can really do anything. They've been as high as 47% or down 39%. Really, it's very difficult to predict anything with any certainty in a single year. Same is true for bonds, though to a lesser extent. Bonds are shown in blue. And even for a balanced portfolio, 50% stocks and 50% bonds, which is shown in gray, again, a wide range of outcomes. But as you move towards the right of this chart, you'll see that over 5, 10, and 20-year periods, you have a much tighter range of possible outcomes and a much higher likelihood that the longer-term results will be quite positive. In fact, if you look at 20-year rolling periods, you'll notice that there has not yet been a 20-year period where a stocks, bonds, or a blended portfolio have seen overall losses. And so hopefully that gives some comfort to those investors who are able to bear these kinds of lessons in mind. And so with all of that said, what we're looking at now with our investment group, we're really focused on where to be selective, how to be thoughtful, and where to find the best value across the globe and across different types of opportunities in the investment landscape. And so we look at history for some indication of how things have evolved recently and over time. And what you're seeing here is how the US market, measured by the S&P 500, compares to the international markets, which is the All Country World Index, not including the US, which is in purple. And what you're seeing is that over time, going back to the tech boom and bust, and even through the great moderation of the 2000s, and obviously the great financial crisis of 08 and 09, and through this most recent bull market, US stocks and international stocks have tended to take turns leading each other versus lagging each other, and often winding up eventually in a kind of similar spot. But that's really not been the case in these last few years. There's been this very significant divergence where the US has outperformed, the international markets have tended to lag. And as a result, we've seen this very wide discrepancy in where current valuations are and where current opportunities may lie. So if you look in this box here in the middle of the chart, you'll see that the US, which is again is in gray, the current valuations, this trailing PE, are slightly above average, its long-term 20-year average. Whereas for international markets, they're both well below the US valuation average and below its own 20-year average. So we're viewing those areas as potentially cheap and much more ripe for potential opportunities going forward. And you'll also see that in an environment where obviously fixed income yields are very challenged and dividend yields may become more important, the international space has significantly higher, over 1.5 times higher, the dividend yield as the US and slightly higher than its longer term average. So that's one space where I think we're particularly focused at the moment. Obviously, there are many unique aspects as to what countries, regions, and types of industries have been able to face the challenges of this most recent period more or less successfully than others. We tend to think that Asia in particular and certain emerging markets in that region have done a better job of being swift with how they've handled the disease and their economies, maybe poised to come out of it sooner and potentially with a more sustained recovery going forward. Even within the US, even though we think that valuations are overall quite average, there's been a lot more bifurcation within the sectors and even different portions of the market there. So just to give you a few examples of where we're looking, energy kind of stands out as a sector that's not just been facing demand challenges from everyone having to stay home, but also from these geopolitical challenges created by the tensions between Saudi Arabia and Russia and OPEC Plus, where they basically increased production at a time when prices were already low to try to force out some of the smaller competitors. So focusing on an area like that, looking for the companies that can really maintain their businesses, use their strong balance sheets in this kind of time period to both survive and then potentially benefit from any consolidation going forward is one particular area where I think it's worth, again, being very aware of the risks, but also very prudent about who might be poised to succeed going forward. An area like healthcare as well is certainly extremely important in a time like this. And then to a significant extent, we're looking at areas like technology and small cap value stocks, which are basically the smaller companies that are tend to be undervalued or have lower valuations than the average. And so those are just a few examples of where we're looking for more short to medium, potentially longer term opportunities. And again, I think it's very important in this time frame to stay disciplined, stay focused on where values really are versus where maybe people are getting overexcited and overpaying for companies that have a good story to tell, but not necessarily equal or equivalent business acumen. And at the same time, maintain that longer term focus. Be disciplined about achieving your goals, not acting overly emotionally with investment decisions, and of course, working with professionals wherever possible. So with all of that said, I'll pause my presentation there and pass it back over to Jesse to begin the Q&A.
Great, and thank you to both Ben and Stephen. That was terrific content. Ben, I'm looking at the Q&A box here, and I see a really good question. You mentioned Obviously, just a moment ago, you talked about a number of areas where Altfest currently finds very attractive in the market. One of those being small cap value. You mentioned a couple of sectors, healthcare and energy specifically. The question is, what is your approach to utilizing active versus passive investment management strategies to capture those areas of the market that we find attractive?
Yeah, that's a really good question, Jesse. So just so everyone's clear as to what we're talking about here, an active strategy is one where there's a manager who's trying to select individual securities that might outperform a benchmark. Whereas a passive strategy is one that's simply mirroring or mimicking an index, not trying to add any value by picking individual securities. And at Altfest, we tend to favor active management overall. We believe that we can identify managers who are able to add value, net of any kind of cost of having an active manager there. But we do also blend in passive strategies as well, because they're often really useful as tools for perhaps more tactical positions. And so we take kind of a core and tactical approach to all of our investments, and many of the core positions are led by very strong and well-seasoned veterans of the active management sphere. And for our kind of more tactical positions where we see short-term opportunities, such as in energy, for example, at the moment, or such as in spaces in the fixed income sphere, we might wind up using a passive ETF to identify and access that particular kind of exposure that we're looking for. Certainly, there's different philosophies out there about those kinds of things, and we do have a breadth of portfolio options for clients that might more heavily favor one versus the other, of course. But I think it is particularly important now where you're seeing much more, again, divergence among regions, divergence among sectors, and divergence among countries and individual companies even, to be very focused on maybe not just buying the entire market and hoping it all works out. Being a little more active and thoughtful about those kinds of things tends to be the better strategy in times like this.
That's a great answer, Ben. And to follow up on what you just said, I think it's very important to be thoughtful in the current environment. And you elaborated on the divergence that we've seen between U.S. and international markets as a great way to find value. Next question would be probably best suited for Stephen. Should we consider Roth conversions in the current year?
We've already had a presentation on that, and the answer to that is basically yes. It's always something that can be thought about almost at every year. It doesn't have to necessarily be done at the beginning of the year. It typically is best to know when you have a really good understanding of what your income is going to be for the year. Roth conversions are set up and to target taking advantage of tax brackets. You want to do it when you have situations where you'll be at a lower tax bracket and you think your future tax brackets that you're paying are going to be higher. So yeah, doing some type of analysis of where your income projections are going to be for 2020. If you already know that the offices are taking somewhat of a setback and you think your income is going to be that much lower, you can start doing it now. You don't have to do it all in one shot. You can do it piece by piece. So if you want to do, let's say, $100,000 over the year, we can do 50,000 now, 50,000 in November when we really have a much better understanding of the year. You want to, as I was describing in my talk, you want to play with the tax brackets and you'd like to fill up the lower tax brackets. If you go over by a little bit, it's not going to make that much of a difference, but you do want to utilize those lower tax brackets to where you think you'll be at later in life.
That's a great answer, Stephen. And I think to Stephen's point, each individual's circumstances are going to be likely quite different from one another. And Roth conversions in particular are a very specific subject. So once again, as we've said throughout this webinar, please feel free, if you are considering doing a Roth conversion this year, please feel free to reach out to us and we will go over your particular circumstances and recommend if we think it might be the right thing to do. I'm going to ask another question here that's come in back to Ben. Ben, I think this goes along with your talk about the fixed income market. particularly in how the yield curve has flattened substantially in recent years. And well, the question is, what can you recommend to provide yield in the current environment?
Yeah, so it's a tough question. I think there's really a lot of ideas out there that reaching for yield may not work out very well, especially if we do see bankruptcies start to rise in corporate debt here in the U.S. or abroad even. Certainly we had a recent day where simultaneously we saw Hertz declare bankruptcy and the country of Argentina declare bankruptcy. So that's kind of a tough sign of what might be ahead for many other places. But one area that we have been quite focused on at the moment is a relatively under-followed part of the fixed income market called non-agency mortgages or mortgage-backed securities. And this is basically made up of collections of mortgages that may be legacy, maybe older and how long they've been around. Some of them may be newer, but maybe given to different kinds of borrowers than just kind of your typical average homeowner. But what's interesting about these is that, especially for the legacy, the older non-agency mortgages, they've often been kind of a darling of the hedge fund world. And in this most recent volatility, they were very much oversold as people needed to unwind leverage, as people needed to kind of create liquidity for themselves. And yet the characteristics of these fixed income positions are often quite sound. People are usually they've built up quite a lot of equity. They have low loan to value ratios. And so they're actually quite well positioned from a technical perspective to be able to earn their relatively higher yields. Not that they're extremely high yielding, but it is a place where you also need to be very careful about what you're investing in. There have been certainly potential securities that have more risk than others in this space. But overall, I think it is a potential opportunity for fixed income investors in this environment.
Terrific. And I have another investment question here that has come in, and this is regarding, Ben, your mention of small cap value as an area that we like moving forward. Can you elaborate a little bit on why the firm likes small value companies in the current environment that perhaps haven't participated quite as much in the recent somewhat significant rebound that we've seen over the past month or so?
Yeah, sure. I think so. Small cap value is one particular space that was hit quite hard and perhaps way oversold during the first few weeks and months of the crisis here. And as a result, even after this recovery started to take place, we've been seeing that area has been left behind somewhat. There may be a few reasons for this. Value stocks in general tend to be a little more represented by things like financials or energy or real estate, and those three areas have certainly been a little bit more challenged than others in this kind of time frame. But at the same time, the average valuation for that particular part of the market is somewhere between 70 and 75% of its longer term average, whereas small cap growth, in contrast, is about 130 to 140% of its long-term average, trading at very significant premiums to their history. And then we look at all the different kind of parts of the market and slice and dice them, but small cap value really stands out as being particularly undervalued overall. But at the same time, there may be obviously additional risks in a place like financials right now, which if there are increasing bankruptcies, that could be an industry that's slower to recover than others. Energy, we have a different opinion on, of course. Real estate has its own kind of functions going on right now, but the other kind of potential benefit from, again, looking at it closely is uncovering those more unique opportunities within it and having experts in those areas identify which companies may be perfectly poised to have very strong future outlooks that have been kind of, sold off with everybody else, kind of the baby thrown out with the bathwater, if you will. Could present some really, really attractive opportunities.
That's a terrific answer, and I won't repeat anything Ben just said. He said it certainly better than I could, and thank you for that. I believe we have reached, it looks like, the end of our questions at this point. Right now, I would just say that, as you can see on your screen, my name is listed there once again. My name is Jesse Frailing. You see my phone number and email address. I can be reached directly at 212-796-8732. My email address, jfrailing@altfest.com. And you can also find out more by visiting our website at altfest.com/dentists. I want to remind everyone once again that there will be a brief survey that pops up after this webinar ends. If you could please take less than a minute to complete that for us, that would be greatly appreciated. And I want to thank everyone once again for joining us on today's webinar. And please feel free to reach out to us with any questions additional that you may have at any time. We look forward to hearing from you. Thank you and have a great rest of the day and have a great weekend.